Good afternoon. Why should we speak or talk about stock exchanges with sustainability? Any financial sector in any country, in any region, is based on or works on two tires, on two legs, on two categories, the banking sector and the stock exchange sector. If any one of those two parts fail, so the economy is in danger. This is why I will give you a certain overview on our exchanges in the Arab region to show you how sustainable is this field in our region. Starting with Arab exchanges overview. Which countries are we talking about? We are talking about 16 countries and 18 stock exchange. Why 18 stock exchange? Because in UAE and in Iraq, we have 2 stock exchanges in each country. Our region we can separate it in 3 categories: the Gulf region, the Levant region, and the North Africa region, going from Saudi Arabia, United Arab Emirates, Oman, Qatar, Bahrain, Kuwait, Iraq, then the Levant, Syria, Iraq, Jordan, Lebanon, Palestine, and then Egypt, Sudan, Libya, Tunisia, and Morocco for the Africa. We don't have Algeria because the stock exchange there is still treating only fixed incomes. The repartition of our stock exchanges by market capitalization. Market capitalization, which is the total of listed stocks on each exchange multiplied by the price. So the total of the market capitalization of our stock exchanges, as you see it, is around $1.4 trillion. The main and the biggest stock exchange in our region is the Saudi Stock Exchange, which is capitalized now at $590 billion. Soon it will reach the $620 billion with a new listing which will occur in 2 or 3 weeks. Then we have Qatar with $200 billion, and we will have Mr. Rashid Mansouri here to talk about it in a later stage today. And we have Abu Dhabi with $127 billion market capitalization. We have Mr. Rashid Al-Balushi also with us today, and I will leave this part for them to talk about their exchanges. So as you see, 42% of our market capitalization is held by Saudi Stock Exchange, then Qatar 14.55%, and Abu Dhabi Securities Exchange 9.16%. Now, value of transaction. We see that the value of transaction, which is the value of trades by dollars in our region, total $782 billion, with 66.45% held by Saudi Stock Exchange. Why 66%? While the market capitalization held by Saudi Stock Exchange is like 42%, is because of the liquidity in this market is big. We have like 90% of the traders, they are individuals with a high wealth, so they are trading several times, sometimes per day, and we have a certain liquid market representing 66% of the region of trades of the region. Then we have Dubai with 12%, Qatar 6%, Abu Dhabi 5%. I was talking about the liquidity. Liquidity, we can translate this word by showing the turnover velocity. Turnover velocity means the value of shares traded over the market capitalization, how much the market capitalization is turning. Sometimes we turn it 1 time, sometimes less than 1 time, and sometimes a little bit more. For our region, we see that Dubai financial market has 102% of turnover velocity. If you have, let's say, $100 billion or $100 trillion, if you trade $100 trillion per year, then you have the equation equal 1. Now, for Dubai financial market is 102. Saudi Stock Exchange, the turnover velocity is 88.12. And Egypt market is a liquid also. Stock exchange was 44.49%. Then Abu Dhabi, 32.78%. And Qatar, 23.64%. What I would like to say that for those exchanges, they improved a lot from last year to this year, their liquidity. And when we talk about sustainability, we talk about market capitalization, but we talk also about the liquidity, because liquidity attracts investors. Investors, when they invest in any stock exchange, they would like to know that they can get in, but more important for them is to know that they can get out whenever they want. So finally, the average of our turnover velocity is 56.48%. What does it mean? It might be 30%, it might be 100%. Is it the right number that we have to have? This is why we will compare it to international norms. It's not international norms, but international averages. The Arab Federation of Exchanges, value of transaction, as I've said before, $782 billion, with market capitalization $1.4 trillion, which gives 56.48% turnover velocity. Compared to the World Federation of Exchanges, which is the federation regrouping most of the stock exchanges in the world, the total value of transactions is $55 trillion, with $64 trillion as market capitalization, which give us 85.94% turnover velocity. So we are still less liquid than the average of the world. Value of transaction will represent 1.42% of the value of transaction of the whole world. Yes, some people might think that 1.42% is not enough, but we are talking about the whole world. So 1.42% is not really a little. And as market capitalization, 2.17% of the whole world exchanges market capitalization. Let's see how our exchanges performed since the financial crisis in 2008. All of you know what happened in 2008. So we had this kind of more than a crash. It's a financial crisis, which is the second financial crisis by its amplitude since 1929. And we can see that Qatar Exchange, from the bottom of the bottom, do you know when was the bottom of the financial market crisis? In 2008, it happened on the 9th of March, 2009. We reached the bottom for most of the stock exchanges all around the world, the 9th of March, 2009. And since then, Qatar Exchange performed 227% since the bottom, with losses recovered. What does it mean, losses recovered? And what's from the bottom, the performance, and what's losses recovered? It's very important when we say, I performed like going down from $10 to $4, or $10, let's make it simple, $10 to $1. If in any crisis, any company lose its price, go down from $10 to $1. Then we have the stock going up from $1 to $2. Wow, it makes 100% performance. It's nothing. 100%, but it represents only $1 over 9. So it's very little. This is why we don't only compare the performance of a stock exchange or of any stock, we also compare how much it recovers from the losses. And here we can say, or Mr. Rashid Al-Mansouri will tell you, if someone invested before 2008 $100 on Qatar exchange, did he recover his losses? Yes. He recovered his losses, and today he has $112, even after the crisis. And this is something that we cannot find everywhere those days. Also, we have Abu Dhabi. Fortunately, we have the best performance now with us today. Abu Dhabi also, they performed 139%, and 98%, those who invested $100, now they recovered almost like 98.27%, or 98 dollars from the $100, which means they almost recovered all their losses. And sometimes you will see, I'm just telling you how to analyze figures. Sometimes you will see some exchanges performing 253% from the bottom, but losses recovered 73% only. Why? It means this stock market went too low during the crisis. It was so volatile, so it went too low, and now even when it recovered 253%, it's still at 73%. Someone who bought stocks with $100, he is still at $73. He still have to recover like a $17, more $27 from here to recover all his investment. Same for Egypt, 190, but they are still at 74%, which is excellent. Which is excellent for the average of the region. How we can know if it's excellent or not? Again, we will compare it to the world average. The MSCI World Index. MSCI World Index performed 141% since the bottom of 9 of March 2009. Again, we see that Qatar and Abu Dhabi performed better than the world MSCI Index. Even better. They performed because they are emerging markets. Normally, they didn't have to perform better than the world market. They had at least just to perform better than the MSCI Emerging Markets Index. In fact, they are much, much better than this. They performed better than the MSCI Emerging Market Index, which only performed 121% and recovered only 62.32% of their losses, its losses. So Saudi Arabia performed better than the emerging markets, Egypt also, and Dubai also. All of them performed, and we see that 5 of our best and biggest stock exchanges performed better than the MSCI emerging market. SPAFE 40. SPAFE 40 is our index created by the Arab Federation of Stock Exchanges with S&P Dow Jones Indices, and this index performed 84% with 49% or 50% almost of recovery of losses. I won't be long by explaining all those numbers. You will have them on the PowerPoint because I think we are late on the schedule. Let's go now for something very, very important. I was talking with some people, with some colleagues, those 2 days about the equilibrium between technical analysis and fundamental analysis. Did you hear about technical analysis, fundamental analysis, the challenges between those two ways of analyzing the stock market? Which one to choose? There are a lot of papers that we've read about this. If technical analysis, which analyzes stocks with charts, with indicators, gives any indication that the market is in a good health, that we have a bull trend, that we are going up. But if this analysis is not sustained by fundamental numbers, it means if one day we fail, sometimes we have what we call a bull trap. The market technically will show that it will go up, and then suddenly it turns and go down, and then it broke its support. What can we do? And here we have a panic. We are panicking. But if you bought stocks with fundamentals that tell you that those stocks are really solid, so you will think it's a correction. This is how we can define if it's a correction or a trend return. The trend it will not be turning if the fundamentals are solid. Warren Buffett, all of you heard about Warren Buffett. He said, if you want to really invest and secure an investment, buy stocks that you think if the stock exchange will close during 10 years, you will be able to sleep without any problems. So having good fundamentals, this is how we will sleep at night when we are holding stocks. Technical analysis is very important. I will give just the combinations that I recommend for this. You use fundamental analysis to choose which stock, which company to buy. But should I buy it today? Should I buy it next week? This is where technical analysis will tell me. Buy it today or tomorrow or next week or next month. So let's have a look at those fundamentals. Muscat has PE ratio 11.4 and PE ratio 9 months annualized 11.1 and price to book value 1.6. Just I will give you a brief definition of those three figures. PE ratio means if I invest $100, when can I get back my money with the return I will get from this investment? So if I have a PE ratio equal to 10, it means I will have my money back in 10 years. If I have it in 10 years, it means I will have a kind of 10% return. Am I wrong? 10 years on $100 means 10% return. How can I compare it? I will compare it to bank's interest rate. If the banks are giving me 2%, 3% on dollars investment or dollars deposits, so I'd rather invest my money with 10%. When I'm talking about 11 PE ratio, 11, it means like 9% of return per year, which is much better than depositing your money at the bank. Same thing here. We can see that Abu Dhabi has a great figures here. 12.9% on 12 months, but if we take this year, the 9 months annualized, we'll see that we are at almost 11 at PE ratio, which is great. With 1.7 on price to book value. I didn't give you any hint on price to book value. Price to book value, the book value is in accounting, with the accounting, what worth this stocks. Here, this is the average for the whole stock exchange, all companies listed on the stock exchange. So 1.7, if the book tells you, the balance sheet tells you it's worth 1, normally it's 1. So 1.7 takes in consideration the know-how and the brand of the company and the expectations for the future. Normally, we are good with 1.7 until 2, until 2.5. With PE ratio at those levels, we are still very good, fundamentally wise. I gave you those, I will not go deeply on the details on those numbers. I'm sure that my colleagues will give you for Qatar and Abu Dhabi more details about them, just to tell you that fundamentally we are well based in our region on the Arab stock exchanges. Let's go now for the opportunities of Arab exchanges. The main events that we've had recently are MSCI moved, and Standard & Poor's moved the UAE and Qatar to emerging markets index, which give them the exposure to all international investors. They put them on the loop for international investors. Now they are interested in investing in this region. This is why we've seen a certain improvement on, for the investment in our region after this upgrade. Qatar increased foreign ownership limits to 49%, and Saudi Arabia will open their market to foreign investors in the first half of 2015. Those are the main events that will affect and will affect our market in the region. Now I'll give you some charts quickly just to give you an idea, just visually, to see what's happening in our region. I will not stay long on each chart because analyzing each one will take maybe hours. So this is the S&P AFE index, which is the index of the Arab region, created by the Arab Federation of Exchanges. So we see that we were consolidating since 2009, and now we are out of this range going up with several up and down moves, but we are still here up of this channel. This is MSCI emerging market. We've seen that with the Arab region, we started here in 2012 to go up, while the emerging market, they went up from 2009 till 2012, and then they are consolidating. So it's our turn now. This is where the opportunities are. It's in our region, while the other emerging markets, they are consolidating. Maybe we've missed this part for the MSCI World Market Index, because when the MSCI World Market was going up, for us, we were still here. And then in 2012, now we are going up with the international, but it's not due to international markets. Our markets, sometimes we say they are very correlated to international markets and to oil prices. Is it true? We will see it later. It's not true. It's not true, and the figures, numbers, will give you this, the answer. And even now, you can see if we were really correlated, why this market was up here while we were down. And now we are going up. It's coincidence, maybe. Dow Jones Index, this is something interesting. The Dow Jones Index now is much higher than the top of 2008. I will go faster now. Yes. So correlation between Saudi Stock Exchange market, because the bigger market in our region, and the oil producer. Okay, I still have only 5 minutes. Based on monthly changes, the Saudi Petrochemical Index, tracked since 2007, has a fairly strong correlation to Brent crude oil, 0.65. It can go till 1, from -1 till 1. So there is a correlation relatively high for only petrochemicals. As for the whole stock market index, we just have a correlation of 0.36 over the last 10 years, which is low correlation. So I don't accept what some medias and some analysts say, that we are highly correlated to oil prices. And this is sustainability. We are not that correlated to oil prices. If oil prices go up or down, we have our stock exchanges with their own solid fundamentals. This is a light crude oil, for example, which show that we are going up now since 2012, while the oil was consolidating. The oil was going up while we were consolidating, so there's no correlation. Correlation is only sometimes with petrochemical companies. I will not stay long because I still have 3 minutes. Saudi Stock Exchange Index, Qatar Stock Exchange Index. This is the only market who broke higher than the highs of 2006 and 2008. We have Abu Dhabi, which is close to the high of 2008, and we hope later that it will go up its hopes. We cannot guarantee anything. And the Dubai market, when we said that it performed well but still need certain range to reach the top of 2008. We'll go Egyptian, Kuwait Stock Exchange, Muscat Securities Exchange, which is still consolidating, and we hope that in the second stage, and if we have time, I can tell you why some stock exchanges didn't perform as well as other stock exchanges, but I think we are short on time. Just to tell you, the 5 leading regional investment managers for a survey in September 2014, 13% of them, they intended to increase their investment in our region, with 20% expecting to decrease allocation. Now in October, even with the fall of oil prices, we have 47% are intending to increase their investment in the region. We still expected 20% only to decrease the allocation. And here you have it by country. On GCC, for Saudi Arabia, 53% will increase. On UAE, 46% will increase. And Egypt, 40%. Qatar, 26%. Kuwait, 6%. And to decrease, it's always low percentage of investors are intending to increase their investment in the region. I think I'm really on time to end my presentation. Thank you.